We're continuing the discussion now in equity, and I think this is slide 16 is where we are. We have two learning objectives. We're going to talk about stock dividends and also stock splits and how we account for all these things. This illustration here is about dividends to preferred shareholders. And when you look at this, you're going to look at the equity section. You're going to start there, and you're going to see that they have common stock outstanding. They also have preferred stock outstanding. The captions here are inadequate. They're just summarized. You would have the number of shares issued, you'd have the number of shares outstanding, you would have par, and none of that is given. It's only given here in a short version of what you would normally see on the financial statement, so we can work through our problem. They have cash dividends which are declared. And when it says 360, 500, 700, the first 3 years of operation, you have to be careful about the dates. They mean 360 is in 2015 and 500 in 2016, etc. So be careful with that. Determine the amount of dividends to be paid to preferred and common shareholders in each of the 3 years, assuming that the preferred stock is cumulative and non-participating. What they mean by this non-participating is that they are not going to get any more than their percentage. Now, when you look up here, you're going to first things to say is how much should preferred stock get? In other words, if it were a year and the declaration of dividends was adequate, what's the amount that they should get for this year? And to get at that, you take the 8% times the 6 million. And doing that, you can figure out the amount which they should be paid. 1% of 6 million is going to be 60,000. So 8 times 60,000 is going to be the amount which they should be getting. In your problems, you'll see par and you'll see number of shares outstanding in the preferred stock. Generally, the outstanding and the issued will be the same for preferred because we're not going to be buying back treasury of preferred. So take the number of shares times the par times the percentage to come up with it. And since you know that issued times par is equal to that 6 million, then you could shortcut it and just say 6 million times 8%. So the solution here says the preferred stockholders are owed $480,000 a year. That's that calculation. In the first year, in 2015, when it's $360,000, all of it will go to preferred because preferred get the preference in the payment of the dividends. In this case, they will get the $360,000, all of it. And they did not get, however, $120,000, which they would have liked to have received. The $120,000 will carry forward because it's cumulative, carries forward on to the next year. So in the next year, then you have $480,000 for 2016, which you would like to pay them, but you'd also like to pay them $120,000. But the problem here is in the next year, you only have $500,000 declared. So we can only pay the $500,000, which means they still have that in arrearage. Now, the easiest way to work through a problem like this, and you can continue to work through it, is to put it in a table. And when we get to our homework and start working for the SUA, you're going to see that I create a table. You should go back after watching this and create the table and work through it and see how it's really easy to do if you create the table. Well, as we continue into the last issue in 2017, the declaration here in 2017 of 700,000, when you get to 700,000, you're able to obviously pay the 480,000 for that year for our preferred. You're also having funds left over to pay the preferred for any arrearage that they have, and And so because you paid that arrearage and you paid the $480,000 for that year, the remaining amount will go to common stockholders. So the point, you're getting a number of points when you work through this. You can see that the common stockholders don't get anything until we've taken care of the preferred. And if it says cumulative, you have to take care of the preferred as to their arrearages too. It doesn't just go away, they have arrearages and you need to pay that. The preferred stockholders, you're thinking, well, this is marvelous for them, but if you are an investor, wouldn't you want to be paid interest because they're delaying their payment to you? They have an arrearage in 2017. Well, it's paid in 2017, but it comes from previous year. Why wouldn't you want interest on that? So it looks good, but the fact of the matter is there's no compounding of interest for preferred stockholders. Now, even though you don't pay it to the preferred unless you declare it, I'm going to say that when you invest in preferred stock, you would look at the pattern of behavior, and an investor would assume that it would continue, and they would be continued to be paid this 8% every year if that had been the company's procedures in the past. So when they buy the preferred stock, they would assume that it's going to happen. They would just assume that. So a company is kind of locked into behaviors if they want to keep preferred shareholders happy, and that would be to declare dividends and to pay the preferred shareholders. That is just the nuts and bolts of the thing. Here's a problem then. Again, working this out, putting it in a table is the best way to do it. Shareholders' equity of this industry includes $200,000 of $1 par common stock and $400,000 of 6% cumulative preferred stock. So in my problems, I don't tend to have the participating and non-participating in there. If it is participating, it means they could actually get even more than the 6%. I'm not going to give you, as I said before, the participating, non-participating feature in a problem. So 400,000 times 6 is your basic calculation there to figure out how much that they should be getting if it is declared. And you see that in the first year, this is where I'm cautioning you about the order in which you see things. The first year you need to start with is going to be 2014, which is 40,000. And you know that 1% of 400,000 is 4,000, so 6% is going to be 24,000. So magic number here is 24,000. And you notice that in 2016 there's 50,000, but in 2015 the dividends which are declared are not going to be adequate to cover that 24,000. So you can see in the setup before you've even started that there's going to be some issues and there's going to be an arrearage happening here. So I'll show you here the explanation of how we work through it. So in 2014, in this year, you would have 40,000. So you can pay them, assuming this is the first year of that company, there's no arrearage. You would pay them the total 24,000. And since it's 40,000, which is declared, the common will get the 16. And then I will go on to the next year. In the next year, we only have 20,000 declared, and this is where I said you can see you're going to have a problem, because the 20,000 will all go to preferred, and because they should have been paid 24, there's 4 in arrearage that's going to have to carry forward. So before the common will get anything in 2016, if it's declared, you got to take care of that arrearage for the preferred, as well as paying them what in 2016? The 4. So automatically you can see in 2016 the preferred are really owed then the 4 arrearage from 2015, and then the 24, which they are normally owed for 2016. And indeed, since it's a $50,000 dividend, we were able to completely satisfy the preferred. They're brought up to date in 2016. There'll be no arrearage left over. So we've taken care of them, and because we have completely taken care of those preferred, we have 22,000 that we can pass on to the common. The cash dividends, this is probably something that you have already seen when you were in 201. Stockholders are generally not guaranteed dividends, except for that issue we just had with preferred, and they only get it if the dividends are declared. There are a few important dates to know here. On the declaration date is when you are going to actually create a liability, which is a dividend payable. Now, if you are giving stock dividends, you don't give dividends in payables, because a payable implies the payment of something in cash. Yeah, you don't have a payable. You have stock that will be distributable. Okay, so there's going to be a terminology difference when we get into stock dividends. But stock dividends, I'm going to teach it as a debit to retained earnings likewise. But there's a little difference because you don't create a liability. You create something that is a dividend, which is a distributable amount in stock. Now, nothing happens after that until we get down to the part where the payment is made. And when the payment is made, you're going to remove it from dividends payable, and you're going to pay it just like you would any payable. Accounts payable, when you pay it off, you get rid of that payable, you pay the cash is credited. Same thing happening here with cash dividends. Now, again, when you're talking about stock, and you're going to issue stock as a dividend to people and not give them cash but give them stock, if you give them stock, then the stock that had been distributable now becomes common stock. It's just the same as if the stock had been issued, except you're not, of course, getting cash in, you're taking it out of retained earnings. So that's kind of your setup, and going from what you know about cash dividends to stock dividends, because I think stock dividends and stock split are the harder topics in this section. Property dividends, now this is when you want to give out from your company something of value to your shareholders. It's hard to imagine a time when you would do this, frankly. But let's say that you have a small company, there aren't very many shareholders, and maybe it's a controlled company where only a few people are really running the company, but it's organized as a corporation, so you have a few investors. And you have some property that you don't want, but the people who are controlling the company, they'd like it. They'd like to do something with real estate. And so you're going to give away this real estate. You intended it first maybe to build a plant. You're not going to build a plant. You need to get rid of it. So the board of directors, they say, well, why don't you just give it to us? Give it to us. Well, the first thing you have to do is you have to increase the value of that property to its fair value, recording any gains or losses associated with it. Then you're going to remove the property in total from your books and distribute it to those investors. So the point I want you to understand here is that when you have property dividends, you're going to have to mark it up to fair value, and then you're going to distribute it. And it goes out of retained earnings. Stock dividends. Now, the first thing, I have to think about it when I'm teaching, and I say, oh, it's like an outline, and I have this dichotomy, and there's this classification, we handle it this way. There's this classification, we handle it this way. We had that in pensions. We had that in leases, right? So now we're on stock dividends. You kind of got the same thing going on here, because if you have stock dividends that are very small in in amount, and usually that's defined by the number of outstanding shares of stock. So you're going to give out 25% of outstanding shares of stock. So you had like 100 shares of stock outstanding. What you're going to do is you're going to issue 25 more shares. That's what we're saying. You're going to issue 25 more shares. Well, if you issue 25 or more shares, the general rule when you do these stock dividends is to go up to fair value. In other words, you're going to be taking out of retained earnings the fair value of these shares of stock that you're distributing to shareholders, the fair value. If it's a large number, which is 25% or more, that's the second one I'm discussing here, that's considered a large stock dividend. If it's a large stock dividend, because the fair value of that stock could be quite high, you're taking a lot out of retained earnings. And so if it is a big amount, you have options. One of those options is to record it at par. And so instead of taking the market price of the stock out of retained earnings, you're taking the par value of the stock out of retained earnings. That's something that could be done. But my note down here is that if the distribution of stock is 25% or more, typically you don't do a journal entry. You'll do it as a stock split. I'll discuss stock splits in a moment, but just keep that in the back of your head. Now, if it is a small amount, which is less than 25% of outstanding shares of stock, so in my example of 100 outstanding shares, maybe it's 13 shares or 12 shares or something like that. When you do this, you don't use par to determine the debit to retained earnings. You use market value, which means when you do your credit, you're going to do a credit to common stock and a credit to paid-in capital, and it's going to be the same thing as if those shares of stock had been issued in the marketplace, and that's how you handle it. So there's two ways of handling it, depending on whether it is a big stock dividend, which is 25% or more, or it is less than 25%, which is a small stock dividend. Here is a 10% stock dividend. The magic number was 25%, so this is a small stock dividend. They give you both market value and they give you par. So you have to know the concept to be able to do this, and the concept is if it's small, use market. So market value on this is $12 a share, and 12 times the 10 million shares is going to be 120 million, and that's the debit to retained earnings. And if you remember our rules about common stock always being credited for par times number of shares, you'll have no problem with this, because that's going to be 10. And the paid-in capital in excess of par is going to be the difference between market and par. Now the interesting thing here is that, if this, let's ignore that 10% and just pretend that it had been a large stock dividend. If this had been a large stock dividend and it had been more than 25% or 25% here, then the way you would have done that is your retained earnings would have been debited not by the 120, but by what? Right, it would have been debited by 10. So you see that creates a significant difference in your, they call this a reclassification of equity from retained earnings to your contributed capital. So from between earned and contributed. It's a big difference depending on whether it's small or large. Stock splits. All right, now stock splits, what the stock splits do, it can be very confusing when you're looking at it. I think part of the problem in a stock split is if you read this and it says the board of directors declared a 2-for-1 stock split. Well, that doesn't mean that 2 shares are going out for every share of stock. So in other words, maybe you had 1 share, you issue 2, now you have 3. It does not mean that. It means, as I say in this third sentence of that second paragraph, it means that for every 1 share that's out there, those shares will be called back in and 2 shares put out. Now they don't call it back and put it in a treasury. It's not a treasury stock transaction, so don't be confused by that terminology. We are just saying that if you started with the 10,000 here for Mary, you're going to end up with 20,000. All right. So the number of issued shares will change. The par value of the stock will also be affected in these transactions. But the common stock account, the total dollar value in common stock, remains the same. Before the split, we had 10,000 shares at $10 par, or $100,000. After the split, you have 20,000 shares. The par changes to 5. The total common stock value in there does not change. However, since you have more shares outstanding, also the market price per share will change. So you might want to read, if you haven't already, the introduction which discusses how this all affects the market price, because that is really what we are getting at when we do these effects. The stock splits will effectively reduce the traded value of the stock. So a 2-for-1 will typically cut it in half. But let's say you wanted to change that. Let's say instead of cutting the price in half, you would want to increase it. Now you're going to say, well, why would you increase? You've told us before the reasons for reducing. Why would you ever want to increase? Well, the stock exchanges have rules, and the rules say that if the stock price gets below a certain amount, it's no longer traded, and it's delisted is what they call it. You don't want to be delisted, so instead you do a reverse stock split. So you would recall every share of stock or every 2 shares of stock and give them 1. All right, so it's kind of the reverse. Instead of having the number of shares, you will double the number of shares. It says on the slide there's a handout on financial statement equity transactions. I'm going to be giving you an assignment, and that assignment will be replacing that handout.